Well, it's an ugly day for the NASDAQ. You know that by now. We're looking at a 3% decline. We're right there. I mean, the Dow's down 750, but the NASDAQ has certainly sold off harder. Big declines in chip stocks today and some of the mega caps, too. It's all about those trade tensions with China renewing themselves today based on a presidential social media post. So we'll continue to follow that. We'll bring in Mohamed El-Erian now. He's Allianz Chief Economic Advisor. It's good to have you. Thanks for joining us as we try and take our viewers through these
Allianz Chief Economic Advisor.
It's good. What do you think about it?
Thanks, Scott. I'm not surprised at all. I'm not surprised to what's happening in equities, what's happening in the bond market, what's happening to gold, what's happening to Chinese ETF, because we've had two bits of news today that challenge something that was deeply rooted in the marketplace. Because that growth is sound, inflation is stable, the Fed is going to continue cutting, and policy volatility, the worst of it is behind us. So it doesn't surprise me. The social media post by President Trump is that phrase, massive increase in tariffs. And don't forget, we're talking not just about direct tariffs, but also secondary tariffs. So there is quite a big scope. And this comes at a time when the market assumed that things were fine, and by November we would have a friendly announcement. And then the second one that's flying under the radar screen, but it matters, the second announcement is the layoffs are starting, which questions the notion that this is just a regular shutdown, where once we reopen, everything will be fine and the markets would just look through it. So it's two bits of news, a big bit of news and a secondary bit of news that is causing us to question what has been very friendly assumptions about the environment in which the stock market has gone from record to record.
So you really think that maybe this is the first showing itself of the shutdown, which the market had all but ignored up until today, if in fact it is, as you suggest, thinking about the layoffs that, were announced via social media posts from the head of OMB, as well as this escalation with China?
I do, because the market had seen this movie before, the shutdown movie. We thought we knew how it ends. It ends by people getting paid for what they've missed and no layoffs. And now suddenly there is a higher probability, it's not overwhelming, but there's a higher probability of permanent layoffs. Now you're dealing with the bit of the economy, the K-shaped economy that's already vulnerable. So this is another development that is pulling the rug from a working assumption that was actually a very comforting working assumption, that this is the same movie, we've seen it, we know exactly what happens.
No, but you talked about these assumptions earlier, where you almost suggest that the notion that growth is sound, that's the word you used, and that the Fed is going to cut more, aren't based in reality. I mean, the growth is sound. The economy is sound. I mean, we're according to Atlanta Fed, 3.8, and we know the Fed's going to cut more, Mohamed, don't we?
So first, I think the economy is sound. I want to argue this is distributional effects, but you don't want to push the lower segments of the population too far. Why is it sound? Because of AI. AI has a significant direct and indirect effect on growth. The direct effect is all the investment in the enablers. The indirect effect is through the wealth, the fact that people feel wealthier and may spend more. So this AI engine will continue. What is more in doubt is the consumption side, which normally has been a big driver, and particularly the consumption by lower income households. But this is a sound economy, don't get me wrong. It's certainly better than anywhere else that I look at, and that includes Europe and China.
Let me ask you about the so-called final five, which we believe is left out of a larger pool of potential successors for Chair Powell. It's said to be Bowman, Waller, Reeder, Warsh, Hassett. We'll show you a wall here that we've created to capture that as this process appears to be winding itself closer to the finish line. What do you make of that group, if that is in fact the last five, before we find out an actual name?
They are a very solid five. All of them have experience. All of them have an amount of economic training that is significant. I'm comfortable with the five. I have preferences among the five, but any of the five would be a very credible replacement for Chair Powell.
I mean, do tell, right? You don't shy away from expressing your opinions. Who do you think would be best?
So I think of the five, three dominate. Two that I know personally, a third person that I got to know through his many speeches. So the two that I know personally are Rick Reeder and Kevin Walsh. They're both incredibly capable individuals and would make very good Fed chair. Chris Waller has really stepped up in recent years and has been much more open about how he's thinking, and he would also make a really credible Fed chair. The other two, I simply know less about their views on monetary policy than I do the first three.
Which one do you think would be best for the markets, that investors would say, okay, that this speaks our language, so to speak?
The two that know the markets best, and that is Rick Reeder and Kevin Walsh. They are familiar with market developments, they're interested, they have a really good feel for technicals, something that the current Fed board lacks. You don't have a really good sense for market technicals, which is really important. So those two are known commodities that have a significant amount of market and economic expertise.
Mohammed, we'll see you soon. Thank you. Appreciate it. As always, Mohammed El-Arian.
Thanks, Scott.
All right. Be well. Up next, 314's Warren Pies. He talks about this sell-off today. The Dow down almost 770 points. NASDAQ's down 3%. We're back after this. Well, we're 800 down on the Dow with about 20 minutes to go. It's 820 or so. Every sector within the S&P but staples is red today. Technology, obviously, is the worst, down 3.5%. But declines in discretionary stocks and energy, cyclical areas of the market are certainly getting hit. Industrials are down some 2% as we track these final moments of this trade for this week. Warren Pies is 314 Research's co-founder. He joins us now. I'm looking at 3.3% down on the NASDAQ. Is that what catches your eye the most?
Yeah, thanks for having me. It does. I mean, that's where the leadership's been, so it's not surprising to see that's what's giving the most back. You know, when I it's a little bit of a stressful day, I guess, but when I zoom out and look at the market and where we've come from, we've gone now 119 trading days in a row without a 3% pullback on the S&P 500, and that's the 7th longest streak without that kind of a pullback. Historically, going all the way back to the 1950s. And when you look at those streaks, we've returned like 28% before today. And that's the strongest performance we've seen within any of those streaks. So when I think about it, this is just, I think, a needed correction and a needed pullback, something we've been waiting for. Sentiment's been extreme. Talks of bubbles, talks of doubling between now and March of next year, and analogs to 1999. This is healthy. We're in this window where you'd expect it in October, and that's how we're approaching it as of now, as a healthy pullback.
But I mean, sometimes you look at these things, and it sounds like this is what you're suggesting is we were overbought, we were due for a pullback, and now we're getting it. And sometimes you can't point to an actual catalyst that would send you into that sort of atmosphere in the market, whereas the difference today is we have a serious catalyst, and it's a renewal of tensions between the United States and China. We're talking about the possibility of more tariffs, not less. The market had sort of been anesthetized to the whole issue because we haven't really talked about it all that much, and it figured this too shall pass, and we'll get on to talking about rate cuts and positive earnings. But now we have a serious concern to think about, depending on what the president does and if he does it.
Yeah, I mean, it's a concern. I've been a little bit in recent weeks talking to clients and saying, you know, we were so concerned about tariffs, and tariffs are a real drag. And we didn't have a full taco from the first round of tariffs, really. And so we've expected somewhat of a fiscal drag. Our recommendation for clients is to keep a full equity position and then have an overweight bond position, and in fact have skew towards a little bit of duration. And you can see it on a day like this, because I think that if we're gonna have another flare up in these tariff negotiations or some kind of trade war, I think that bonds will end up being the place that you want to be, because it's going to manifest itself as a growth scare. So that's been the way we're playing it. I think we've gone through this, and ultimately we've already tested the limits of what Trump can tolerate. And I don't think I think the taco trade is still with us. Yes, there could be a little bit of danger in saying that, but if we get a little bit more weakness in this October period, I think you'll see a capitulation on his part, and ultimately we'll get back to where we were, a few weeks ago, and it's just going to be a nice sentiment reset. That's how I'm interpreting it.
Okay. I mean, how are you feeling, though, about risk around the AI trade, which I thought Adam Parker put very well? We have to be really clear. We're not just talking about the mega caps. This trade has metastasized, so to speak, to utilities, a usually boring area of the market that you go to when a safety trade is on, or like a yield proxy. Now we're treating them as the new growth stocks because of AI. And then you say, well, industrial stocks are at record highs. Why? Because of the larger ones that are leveraged more heavily to the AI trade too. So that just brings the risk factor up, doesn't it, when you have so many different stocks under the umbrella of a single trade?
Yeah, I mean, the economy is very dependent on AI. I think everybody knows that at this point in time. And what we do at 314, I work with Fernando, my partner, and he is deep in the AI world. And so we're constantly monitoring things like chip demand, and chip pricing and useful life. And from everything we can see, I think that this AI demand and the AI story is still intact. If yes, it's created a narrowness to the economic expansion, and it would be much healthier to see this rally broaden out. We've all anticipated a broadening, and it hasn't really come. I think we will need a broadening if we're going to get up to 7,000. Some of these more high level targets that you're seeing people throw out. Our target for year end is 6,800 on the S&P 500. We would much rather see a pullback where we can get more long into the end of the year here in October. But yeah, you're going to need AI to do that, and then you're going to need some participation from the rest of the economy. That's where I think the rate cut story comes in. Ultimately, is that if we have rates restricting the rest of the economy. And the hope is that this cut cycle will loosen up some of those other areas. But I don't see anything too real. I know everyone's nervous about the 99 analog, but I'm not there yet. I don't think that the AI trade I don't think it's like seventh inning on it or eighth inning on it. I think we're still in the middle innings.
Let's finish on gold, if we could, because we were just below 4K earlier. Like halftime, I checked it, we're at 39.99 or something like that. And we've had a bid back. There it is. You could see the intraday go right back up to 4,032. We, of course, got over 4,000 for the very first time this week, and there are a lot of forecasts out there that we're going much higher from here. I'm wondering what you make of it, and since you talked about how you're advising your clients in other areas, what are you telling them about this?
So yeah, you're hearing a debasement everywhere. I don't want to take total credit for that, but we've been talking about a shift to a debasement mindset for some time now at 314 Research. I think that coming out of the GFC, the worry was deflation, protection of principal, and we're seeing a societal shift, investor shift to a debasement mindset, and that's protecting purchasing power. I think gold is the biggest beneficiary. We've been on this trade since we saw the Russia-Ukraine war start, and we've seen global central banks buying gold up. That was the first leg of this trade. Our target for the year was 3,500, and it's blown past it. Our opinion is that this is a new secular bull market fueled by this debasement mindset. And when you're in a gold secular bull market, gold can do nothing for years on end, decades, and then it can explode higher for 8 or 10 years. We're in an explode higher phase, and you don't want to call a top. This is not a top on gold. We will be going higher. My view is, if you compare it to old secular bull markets for gold, 5,000 is probably in the bag over the next couple of years. And I think a lot of the things we're worried about societally and globally lead back to gold. So, and it's really interesting to see its strength on a day like this. I think it just reinforces the bullishness.
Yeah, thanks for helping us dig into these markets today. Warren, we'll talk to you soon.
Thanks for having me.
Warren Pye's up next. The green arrows in today's sea of red. Yes, there are some things that are working today. We'll show you where next. All right, we're 10 from the bell. Let's get back now to Mackenzie Sagalos for the look at the key stocks that she's watching. Tell us what you see here.
Okay, Scott, let's take a look at the names in the green today. Despite market pressure, shares of PepsiCo higher and leading the S&P. UBS raising its price target on the Frito-Lay and Gatorade owner, pointing to innovation and cost-cutting as reasons for its confidence. And then auto players, AutoZone and O'Reilly are bouncing back, but both are still negative for the week. And shares of AbbVie are higher as Piper Sandler raised its price target and reiterated an overweight rating. The firm said AbbVie is one of the few among its peers that offers a trifecta of revenue growth, asset durability, and M&A bandwidth. And lately, we're seeing strength in biotech overall as well, Scott.
All right, Mac, thank you. Mackenzie Sagalos coming up next. We count you down to the bell. The final moments of a pretty rough trading day. We've got movers today, tech, consumer stocks, and much more. We'll document it all in the Market Zone, which is next. We are now in the closing bell market zone. PNC's Young Yuma here to break down these crucial moments of the trading day. Plus, Steve Kovac has more on the sell-off in big tech today. And Courtney Reagan is watching consumer discretionary names for us. Steve, why don't you tell us what we've been telling our viewers? This is really bad in tech today.
Yeah, it's really bad. And let me pick out a few specific names for you here, Scott. No one with more tariff exposure than Apple, of course. We've been talking about that much of the year, down about 3.5% as we go into the close. Apple's already expecting about $1 billion hit to revenue in the September quarter due to tariffs. And that's even after it won some relief from the president after CEO Tim Cook gave him a trophy and promised to spend $600 billion within the U.S. over the next 4 years. Now, that even increased the production in India, which has a lower tariff rate, but Apple is still very dependent on China. So an increase in tariffs there will put more pressure on Apple's margins and perhaps accelerate its supply chain diversification. Now let's move over to Qualcomm, because that's down more than 7% today, not just because of these tariff concerns, but also China opening an antitrust probe into the chip maker. Now over to retail, Amazon down nearly 5%. Retail business heavily reliant on Chinese imports, of course. Sellers have been feeling the pressure most of the year. And related to that, all that retail stuff, digital ads and consumer businesses, Alphabet, it's off about 2%. Meta down nearly 4%, currently at its lowest level of the day, Scott. It's just worse from there.
Okay. Yep. Steve, thank you. Steve Kovac. It's good that Steve mentioned Amazon because obviously, Courtney, it has an outsized role in what consumer discretionary stocks do. Not to suggest that there aren't a lot of other names that I know you're watching today.
Yeah, exactly. So Steve hit the Amazon effect. So let's give you some other ones. The consumer discretionary sector writ large is the second weakest of the day here. And this, of course, after President Trump threatens, quote, massive tariffs on China. So the sector down about 3% on the session. Best Buy getting hit really hard, down about 5%, now more than 6%. Remember, its vendors use China for a significant amount of consumer electronic manufacturing. Hasbro, the toy maker, also lower by about 5%. It produces toys in China. It has been working on lessening its reliance on the nation like many others, but still, there is an impact. Nike down more than 4% today as well. It manufactures a lot in Southeast Asia. We talk a lot about the Vietnam manufacturing footprint. But China is also a market for its shoppers. It's an international. It sells there. That has been a weak spot. So further push down on the shares of Nike today. Now, the defensive consumer staples group, it is up just ever so slightly. The only sector in the green, I just mentioned it because it also has the name consumer in it. And we know that there is a big difference between a staple name and a discretionary name for the consumer. Scott?
All right, Court, thank you. That's Courtney Reagan. Young Yuma, as I said, of PNC, is with us. We're going to close either at the lows or certainly near the lows. We're down by, wow, it's hard to even, we haven't seen this in a while. I think that's why it's a little jarring for people. You're down 800 points on the NASDAQ, 3.5%, and down almost 900 on the Dow, Young Yu.
These are big numbers. It is jarring. This is a sea of red out there, but I think it's important amid this pullback and this downturn to keep two things in mind. One is that President Trump didn't actually call off the meeting. I think there's still some prospect that President Trump and President Xi could actually meet at the end of the month. And secondly, the president only threatened tariffs. They weren't actually announced. So this hasn't been taken all the way. We do think this is a bumpy path toward negotiations between U.S. and China, but we do think it's a path that will ultimately start to have some progress. Both sides are carving out very tough negotiating positions, but that's the nature of the tension between these two superpowers.
Mohammed El-Arian suggested that at least some part of what we're seeing today has to do with the government shutdown and the fact that layoffs have now begun. You buy that as well as just one of the other things that's lurking out there, putting some pressure on stocks?
Well, it's in the mix, and there are a host of things, including the labor market, and the layoffs with the government shutdown plays into that. But I think broadly what this does is it injects uncertainty into the economy, into the markets, where before there was an element of complacency. And this also means that businesses that were perhaps thinking about starting to hire again, how they were going to expand, now want to take another pause to see how all this is going to play out. So I think it's that uncertainty that is showing up in multiple fronts, which you could probably ascribe to this big downturn taking place today.
Even those who think a sell-off was needed, they suggest it's going to be short-lived because it will be bought. 10 seconds. Give me an answer on that.
I think there's a floor under it. The macro picture looks strong, and we're still in the exponential upturn for both AI adoption and innovation, and that's a strong place to be.
All right. Appreciate you being with us here as we head towards the close, 20 seconds or so away. That's Young Yumap of PNC. So you're going to close awfully close to the lows. That's where the bell's going to ring us. About 3.5% on the NASDAQ. You got on the S&P about 2.75%. The next hour is going to pick it up, of course, with Morgan and John and OT.
And that bell marks the end of Regulation Credit Corp. Ringing the closing bell at the New York Stock Exchange. Webtoon doing the honors at the NASDAQ as New York Comic Con gets going this week. A different kind of October surprise. A big sell-off in stocks today after President Trump said he was considering a massive increase in tariffs on Chinese products. All three major averages closing just about at the lows for the day. First move more than 1% in the S&P 500 in 33 sessions. First 3% loss for the NASDAQ since April. And the Dow's lower for the fifth straight day. Its worst day since the middle of May. Stocks with China exposure, the biggest drags on the index: Amazon, Nike, Apple, and Nvidia. Tech, the worst performing sector. Chips, a big culprit. Big losses for Synopsys, Supermicro, Teradyne. Those are among the worst performers. Retail also getting hurt. There was already some worries about the consumer. Now throw tariffs on top of it, and big losses for names like Best Buy, Five Below, and Estee Lauder. We got much more on retail coming up in overtime, and the areas people are looking to for safety. The metals worked. Gold still above 4,000. Crypto not as much. Bitcoin down 4%. Ether down 8% today.
Well, that's the scorecard on Wall Street. Welcome to Closing Bell Overtime. I'm Morgan Brennan along with John Fort. Throughout the next hour, we are going to be breaking down today's sell-off from every angle. We're going to be looking ahead to what all of this means for the life of this rally. But let's start with the news of the day. The president threatening massive tariffs on China. Eamon Javers is at the White House with the details. Eamon.
Hey there, Morgan. Well, look, I mean, even though we just opened the show with our big red bear 3D graphic, I mean, I want to give you sort of the bullish analysis of this, as we're now 5 hours since the president tweeted. He posted this social media post about 11 a.m., just before 11 a.m. this morning. So we're 5 hours into this, and we haven't seen any indication from anybody in the U.S. government that anything in specific has actually taken place, right? No confirmation of additional tariffs, no confirmation of additional countermeasures that are being considered, and no confirmation that the president has, in fact, actually canceled his meeting with Xi Jinping. So that's, I think, the bullish outlook in the sense that you get the sense that the president and official Washington are sort of waiting for the Chinese reaction to this when they wake up in Beijing. So table that. Here's what the president said earlier today. Take a look at an excerpt of this very lengthy social media post. He said, one of the policies that we are calculating at this moment is a massive increase of tariffs on Chinese products coming into the United States of America. There are many other countermeasures that are likewise under serious consideration. So what are the operative words there? Serious consideration. He doesn't say he's going to do it. He says policies that we are calculating at the moment, massive increase of tariffs. Doesn't say he's going to do it. So 5 hours later, he hasn't done it. So I think if you're looking at this, what you're looking at is a president trying to rattle the cage of the Chinese government and get them to respond on what they did yesterday, which was rattling the cage of the U.S. president. So there's some rhetoric here. A lot of the old timers in Washington used to call this gorilla dust, when the big gorilla stomps his feet and stirs up a lot of dust. I think we're looking at a lot of gorilla dust in both capitals today, and we're going to have to wait a little bit for that dust to settle to get a sense of what real has actually happened here and what that's really going to mean for the markets. Markets obviously, reacting to the sharp change in sentiment, but in terms of concrete action, we haven't seen that today.
Yeah. We've also had a record run here, so perhaps not surprising to see markets digest this in a more meaningful way today. Eamon Javers, thank you. Well, joining us now is Marco Papik of BCA Research. Marco, it's great to have you on, and that's where I'm going to start with you. You see this, and should investors see this as gorilla dust?
I love that analogy. I thought it was very apt, and yes, absolutely they should. I mean, this isn't the first time that President Trump has used gorilla dust, to use your colleague's great phrase. In fact, I believe that he has always deployed what I call the 7 steps of maximum pressure. And step 5 in those 7 steps is always leaving the bride at the altar. So just when you think that there's a deal, President Trump has almost always, in every negotiation, under all circumstances, always pulled out right before the deal is concluded. And that's so as to get a better deal. And I think that that's why He did not actually cancel his visit to South Korea. He said, I may not go, and then, of course, has threatened tariffs.
I mean, this is just in the last, call it 24 to 48 hours, reported developments here from the China side. These proposed rare earth export controls, which wouldn't go into effect until, I believe, December 1st. You have Beijing saying that it's going to levy fees on U.S. cargo ships docking at its ports. Customs crackdowns on NVIDIA U.S. chip imports, reports of an antitrust investigation into Qualcomm. That's on the China side. On the U.S. side, I don't think we should be overlooking the fact that the Senate, and I realize that there's a couple weeks till this comes together, but that the Senate actually rammed through its National Defense Authorization Act last night, which is the defense policy bill, annual defense policy bill. Very, very hawkish on China. It included the Fight China Amendment, Gain AI, Biosecure, all focused on cracking down on ties with China. So I do wonder if, just looking at all of this landscape, investors were way too enthusiastic to begin with about a big, grand trade deal with China when there's so much at stake from a national security standpoint.
Yes, I think that what was announced by Beijing yesterday definitely motivated this, and it gave President Trump his excuse to ramp up tensions ahead of this meeting. The Chinese added more rare earths to their export controls, and they also actually included machines and intellectual property to allow other countries and other companies to refine those minerals as well to their export control, which was a sort of an expansion of their policies. So yes, of course, there's always something to find in China-U.S. Geopolitical confrontation. The two are rivals. They're going to continue being rivals. I don't think investors were too complacent about that. I don't think anybody expected a truly groundbreaking grand bargain. However, I think investors were just complacent about everything. I mean, this was a buy everything rally that's been going on for several months.
Okay.
And so I think that that's the context in which we should put this.
So, Marco, where you're heading
well.
with that, bringing it closer to investor portfolios, you say big picture here, dollar debasement, kind of cheaper dollar is a big part of the story here. And commodity trades, you're saying, especially precious metals, palladium, platinum, silver, nickel, are the way to kind of combat that. But don't tariffs and the resulting global trade shocks cause imbalances in commodities sometimes too, or are metals shielded?
No, metals could be impacted, not globally, of course. President Trump has suggested he would put tariffs on various metals. But I would just step back and think of this in a different way. To me, the market reaction today is actually quite encouraging. Because, yes, stocks are falling because, again, they've gone up a lot. And I think investors were looking for any reason to be shaken out of the tree branches. But bond yields are coming down significantly, and the dollar has reversed its vicious rally of the last 2 days. And so that is encouraging, because without lower bond yields, you're not going to have any kind of a transition in the U.S. economy towards a more leverage-driven cycle. And that encourages me that we can continue to avoid a recession. And then, yes, some of those metals and precious metals and industrial metals trades can go on unabated.
All right. Marco Papic, thank you. Well, bond yields falling today along with stocks, the 10-year falling back toward 4%. Let's get to Rick Santelli in Chicago for more on that.
Yes, John, I'll tell you, last guest said, bond yields have fallen a lot. And I guess in a cumulative way, maybe, but if you really look at how much stocks moved in percentage terms and looked at all the intensity that this session had, you certainly did not see it in treasuries. Let's look at 2s, 10s, and 30s 6-hour chart. You can clearly see absolutely around 11 Eastern when the stock market and everything was hit on those tariff headlines, all of the maturities moved lower in yield. However, let's put some asterisks here. If you look at a 2-year, its current low yield close of the year was early September at 3.48. We're currently hovering at, 352. Where did we settle last week in a 2-year? 358. Not a huge weekly move. And if you open that chart up, that bottom that we made in September, that goes all the way back to SEP of 2022, and it was unchallenged. But maybe the biggest unchallenged level is 4%. they've been gunning investors trying to hit that 4%. Now, you see that's the low yield close from very early April. I've talked about it a lot. But we didn't really get there. Today, the low yield was hovering right around 404, and right now we're hovering around 406, which means that we're only down 6 basis points on the week. We settled at 412. And if you open that chart up, you can see that that April low that we had, well, that takes you all the way back to October 2024, when was the last time we really started settling earnestly under 4%. So next week, pay very close attention to 2 things. Obviously, the close at 4% in a 10, but also in a 30-year bond. Earlier this week and last week, we tested levels that were the settlement of the year in 2024, right around 4 3/4. We didn't get above it. That is maybe one of the bullish indicators that you could see potentially lower long-term rates. John Fort, back to you.
Rick Santelli, thank you. Well, as we mentioned, all 3 major averages ending near session lows. The Dow posting its worst decline since May, the S&P and NASDAQ since April. The indices closing out with their biggest weekly decline since early August. Our next guest says if the sell-off drags on, it could spark even bigger risks. Wealth Enhancement Group Deputy Chief Investment Officer Doug Huber. Welcome, Doug. A lot of this market run has been driven by the AI story, semiconductors, tech infrastructure, a big piece. Semis got shaken by today's headlines. How vulnerable would you say this market is, its main driver, especially in this AI trade, as this unfolds?
Yeah, absolutely. Thanks for having me. I mean, listen, it seems like a pretty bifurcated market here, right? Either AI execution lives up to its promise, and that certainly will benefit multiple sectors. But if disillusionment sets in, I think this could really drag valuations more broadly. And so there's going to be a lot of attention paid to major questions around what is the long-term ROI of these data center spending? You know, how can they even afford it, you know, given the numbers that are being thrown around? And if there is kind of a growth slow here, what is that growth premium? What is the multiple compression that is kind of the right reset if we do hit the skids?
Any place to hide? Metals?
I mean, that certainly seems the place that a lot of investors are looking right now. You saw it today. I mean, I think there's multiple legs to why gold is certainly been working. I think it started with more central bank buying, but it's probably part of this debasement trade where investors are disillusioned with the U.S. Treasury and the U.S. dollar. And so gold seems to be a safe haven at the moment. I also think if we expect rates to continue to decline, you know, that opportunity cost of a no yield asset like gold certainly goes down. And so gold certainly seems to be a place. Digital gold in the form of Bitcoin sometimes is, sometimes isn't. Obviously today traded more like a risk asset, but you did see treasuries react today in a muted way, and so maybe investors still look to the intermediate and longer end of the curve to hide out. But at the moment, I think it's, as we look to our clients, we really think more long term, and it's just about making sure our risks are in the spots we want them.
How's the government shutdown impacting the bond market right now? And here's why I ask that. Because on the one hand, you have the uncertainty. We're dragging into another week. You're seeing layoffs start to happen, although there's already legal challenges to some of those layoffs. On the other hand, if this is an opportunity for the OMB to go in and start cutting government spending in a bigger, more aggressive way and actually has a case to be made around that, I would think that that would actually help the longer end of the curve and keep those yields under wraps too.
Yeah, I mean, you could certainly make that argument. I think in general, right, the lost wages for furloughed or laid off workers, government contractors, et cetera, certainly means more fears around weaker consumer demand, especially in those local economies that are heavily dependent upon federal work. But I think in general, right, that fear of the fact that a lot of this cycle has really been on the back of the workhorse of the consumer. And so if we see continued weakening there, we obviously have softer labor markets. This isn't going to help that. There is that view that maybe you do want to hide out. And I think there has been some pressure on the back end, obviously, as the term premium's a little bit higher, again, to that idea that we are carrying a lot of debt. I think the natural buyers of the long end are a little concerned. But the fact of the matter is it has been the safe haven asset for a long, long time. And so I do think you're right in that we could see that maybe bring in the back end as fears kind of continue to percolate underneath.
Okay. Doug Huber, thank you for joining us on what was the biggest one-day decline for the Dow since May and the biggest one-day decline for the S&P and the NASDAQ since April. Volatility finally perking back up in what is historically a very volatile month, October. Coming up on Overtime, we're continuing to look at all the stocks and sectors that got hit in today's tariff threat takedown of the markets. Retail, a big loser today. That's despite efforts to diversify. A lot of companies still heavily reliant on China. We're going to dig into those names.
And take a look at shares of Tesla, also getting hit on China tariff news, down just about 5%. Now the stock still is up 20% in the past month. Much more on the sell-off when Overtime comes right back. Welcome back to Overtime. Retail, one of the sector's worst slammed today on tough talk from President Trump on China tariffs. The XRT ETF posting its worst day since May, worst week of the year. Some of the hardest hit names, Five Below, Estee Lauder, Best Buy, and Capri. Let's bring in Oppenheimer senior analyst Brian Nagel. And Brian, you had been saying tariff-driven price hikes were moderating. How much of a concern is this latest dust-up?
Well, good afternoon. No, that's interesting. So you're referring to just this morning, my associates and I published an update to an index we created that basically tracks retail price adjustments across our coverage universe. And interestingly, what we saw in the last few weeks or month or so is that it seems that these tariff-driven price increases have actually stalled out. I do find that interesting. So to answer your question, John, I mean, the data moves a lot, right? But if our index is right, and for whatever reason, retailers have become more hesitant to raise prices. At the same time, now we have fresh threats of now, to use the president's word, massive new tariffs. That's bad, because what that basically means is these retailers are really going to have to struggle to pass along any of these new costs that come through.
And we're in Q4, right? I mean, I'm not sure what you're seeing out there in inventories ahead of the thick of the holiday season coming up. I know that there was some degree of pull in ahead of the threat of tariffs earlier this year, but if retailers have to discount, then that's a problem on the margin side. But if retailers have to re-up, then that's a problem potentially on the tariff side, no?
No, that's exactly right. I mean, what we're heading into is the all-important holiday selling season, right? So for most retailers, volumes are bigger. I mean, you do most of your business in the holiday season. So that basically raises the risks, right, as we head into the holidays. And that's exactly what you're talking about. Now, right now, I'm not seeing any signs of excess promotions. I think the bigger concern as we head into the holidays, going back to the point I was making before, is what retailers do with prices and then the potential impacts that has upon demand. For a while, I've looked at the consumer spending backdrop. The discretionary spending backdrop is okay, but not great. There's a lot of pressures out there on the consumer. To the extent these retailers are basically forced to start continue or raise prices even an accelerated pace, that very likely could further pressure, if you will, discretionary spending.
Yeah, CNBC's Lorianne LaRocca, who's done some great work on this, on the state of freight, basically broke down how the freight data is signaling that the inventory is very lean and mean going into the all-important holiday season. So in light of this whole conversation then, as an investor, given the pullback we've seen in these stocks today, what would you be investing in?
Well, look, and I've said this for a while too, within my coverage universe, the best way to play this tariff backdrop or increased uncertainty with consumer spending is auto parts retail. And my favorite name there is AutoZone. For really the auto parts retailers have a great ability to the extent they choose to pass along higher costs to consumers. And on the other side of the argument, to the extent we do have a weaker spending backdrop, a more cautious consumer, that actually lends well to auto parts retail too, because the basic math is, if you're as a consumer, you're worried, you don't want to buy that newer car, you're more likely to fix your existing car. So again, that's a big benefit for the auto parts retail. So that's really the safest place to play. The other side of the coin, look, we saw, and I think the stocks reflected this properly today. I like Nike a lot here. I think the turnaround is happening. Nike's been very good about calling out, what they view as the tariff exposure. Again, we'll see what happens. The commentary today could change in hours, could change over the weekend. We'll see. But if there's incremental tariffs on China or massive tariffs, as we heard today, that would be another challenge for Nike and its turnaround.
Okay, so bottom line, do you think this could be a noisy earnings season then for the retailers?
I think it will be. It's, again, what we've heard from most of these companies for a while now is that, they've been pretty pleased with their ability to, so to say, implement and execute tariff mitigation plans. But, the longer this goes on, the more difficult those plans become to continue to successfully implement and mitigate. And again, if we have new tariffs, that heightens, that makes more, that's a bigger concern. But I think when I'm talking to my companies across the board, I think what they're most sort of say tired of is just the erraticness of this. They can't get any certainty with regard to what the tariffs will be, where the tariffs will be. It just seems like it's changing all the time, and it's very difficult to manage businesses like that.
Okay, Brian Nagel, thanks for joining us.
Thank you.
Flip side of the coin here is consumer staples was the one sector, John, in the S&P that was in the green, led higher by a lot of packaged food companies, including PepsiCo, I think, as it still rides the wave of earnings.
Still got to eat.
Yeah. Well, markets selling off on China tariff news today, but the government shutdown is still hanging out there as well. Now the layoffs are starting. The latest from Washington. That's coming up on Overtime.
Well, welcome back to Overtime. Let's continue to survey the damage from today's sell-off. Big drop in the price of oil, falling below $60 a barrel, at least dipping below for the first time since May. Worries that a dispute between the U.S. and China could slow global growth. Every name in the S&P 500 energy sector down today. APA, Halliburton, Baker Hughes among the worst performers.
Well, as the government shutdown drags on, OMB Director Russell Vogt saying the RIFs have begun. That's short for reductions in workforce or reductions in force, what we call layoffs of federal workers. So let's go to Emily Wilkins in Washington for the latest. Emily.
Hey, Morgan. Well, yeah, the Trump administration, you remember they announced that they're beginning to lay off federal employees following through on that warning that they made at the start of the shutdown. Now, we don't yet have details on how many employees are impacted or from which roles, but we do know some of the agencies. You got Treasury, Health and Human Services, EPA, Department of Commerce, Department of Education, Energy, Homeland Security, Interior, Housing and Urban Development. All of them have confirmed that their departments are part of the layoffs of federal workers. And you've seen some swift backlash to this already. The Federal Workers Union tweeted that the lawsuit has been filed and then called the firings illegal in a statement. The AFL-CIO also tweeted that America's unions will see you in court in direct response to OMB and Russ Vogt. Now, of course, these firings are only a few of the ways that the White House is trying to pressure Senate Democrats into voting to end the current shutdown. If you remember, Trump has also floated not giving furloughed workers back pay when the shutdown ends, which is currently required by law. And yesterday, he said he would go after what he deemed as Democratic programs. And of course, waiting for more clarification on what these can be. But you do see now, as the shutdown is in day 10, the White House trying to really ratchet up the pressure here and the impacts as we're now set to go into next week. Senate's not going to be back until Tuesday, and that's when we expect the next vote to open the government to be. Guys?
You know, we had Mick Mulvaney, the former director of OMB, among other things, on this very show exactly a week ago. And one of the things he pointed out was that OMB Director Vogt was his deputy for 3 years. He said the man probably knows more about the way government functions than anybody in Washington, and that they've been waiting for this period, a.k.a. shutdown, for this opportunity to do stuff like this for a long time, because it's a different legal dynamic than when the government's fully funded and fully open.
I mean, Morgan, that's definitely a case that Russ Vogt and the White House are making. You're also seeing the unions as well as Democrats saying that actually it's just the opposite, that a shutdown does not give the White House any additional abilities to lay off or to fire federal workers. And in fact, that during a shutdown, only the essential functions are supposed to be formed, which means that things like a reduction in force aren't supposed to happen. And you actually have seen some pushback from a few Republican senators who are saying that this is not the right time to be laying folks off, that the government needs to focus just on the essential functions. And of course, this is all coming as lawmakers are trying to piece together the funding for the next fiscal year, including the size and the scope and the roles of some of these departments. So a lot of things going on here. We'll probably see this decided in the courts.
Emily Wilkins, thank you. News update with Mackenzie Sagalos. Mackenzie.
Hey, John. 19 people are dead or missing today after a massive explosion at a munitions plant in Tennessee. That's according to the local sheriff. The cause of the blast at Accurate Energetic Systems was not immediately known, and local authorities said the investigation could take days. The company said the facility develops, manufactures, and stores explosives for defense and commercial markets. Defense Secretary Pete Hegseth and Qatar's defense minister signed a deal today, greenlighting a new Qatari Air Force facility in Idaho. Qatari pilots at the facility will train to fly F-15 fighter jets alongside U.S. soldiers. The facility will be built at the Mountain Home Air Force Base. And Banana Ball is about to get bigger. The founder of the Savannah Bananas announced 2 new teams will join the entertainment-based, fast-moving baseball league. He says there are scheduled appearances in 75 stadiums next year, including 14 major league parks and 10 football stadiums. The league drew 2.2 million fans this year and hopes to grow to 3.3 million in 2026. Back to you guys.
That's bananas. All right, Mackenzie Sagalos, thank you. President Trump's tariff comments not the only thing weighing on stocks. Many big home builders losing 10% of their value this week after the president pressured them to build more. We've got that story coming.
Another group having a bad week, auto stocks. Ford's worst week since August of last year. GM and Stellantis also sharply lower. Much more on the sell-off coming up. Welcome back to Overtime. Big sell-off for stocks after President Trump threatened massive tariffs against China. The losses for the S&P and NASDAQ were the worst since April when tariff turmoil gripped the markets. Today's loss is sending all three major averages down more than 2% for the week. Before today, we had a steady climb to records for the markets. This was the S&P 500's first move more than 1% in 33 sessions. That's the longest gap between big moves since 2020. Retail, semiconductors, and energy, some of the hard-hit groups, XRT and SMH, having their worst days since April. As for energy, as I mentioned earlier, oil falling below 60 for the first time since May.
Well, let's turn to the home builders, because the sector had a rough week. After President Trump pressured home builders to ramp up construction, the home construction ETF down more than 8% this week. It was the worst week since 2022. D.R. Horton closing out its worst week since June of 2022 was one of the biggest losers in the S&P 500 as well. And as the stocks fall, the PE ratios coming down with them. KB Home trading at 10, D.R. Horton around 12. So are these names now cheap enough to buy? Let's bring in John Lovallo, home builders analyst at UBS. John, it's great to have you on. I mean, we had seen just a massive run in the home builders coming into that first Fed rate cut and then even coming out the other end of this. How much of this is profit taking? How much of this is policy changes and the idea that maybe the home builders are out over their skis?
Yeah, thanks a lot for having me, Morgan. The tweets that came out this week were tough on the group for sure. I mean, basically suggesting that the group was hoarding lots, not producing enough. Frankly, what it comes down to, if the builders have done nothing but the very rational thing in pulling back on production. There's been inventory that's built up in certain markets. They're trying to clear the decks for next year. If they were to push more, honestly, I think that the outcome would be they'd be pushing on a string. The consumer confidence is not there. I think you risk damaging consumer confidence even further as existing home values come down. So to answer your question, look, it was policy, but also the stocks that had a nice run. I think that this has probably been the most hated rally that I've seen in a long time. And the shorts were kind of looking for an opportunity to step in and get more negative, and that's what we saw this week.
So we just talked about the fact that that the valuations of the stocks have come down too. Would you be buying anything here right now?
100%. We're decidedly bullish heading into the new year. In fact, we have an internal team here called Holt, which is a cash flow based valuation metrics team. They've said that the group is now as dislocated from the market as at any point in the past 10 years. And when they've hit this point, over time, the relative returns versus the market have been in excess of 50%, 50%. The group is very cheap. And these are changed businesses that generate cash through a cycle, are doing the right thing with capital and returning capital to shareholders, buying land off balance sheet, very under-levered balance sheets, just very good businesses.
So, John, subprime lending looks bad in cars right now, so it seems risky to incentivize too much anywhere. How many new homes can the builders sell?
It comes down to consumer confidence. It really does. I mean, we're running at decent levels. Could they push single-family starts, from call it 937 this year up to 1.1 or 1.2 million units in a good market? Yes, that's possible. But again, you don't want to flood the market with inventory when it's not receptive. The consumer confidence needs to improve. Affordability is a challenge, but you know what? The builders have been able to buy down rates, and that's actually changed the affordability equation amazingly. So look, if the government really wants to do some things to help, I think the Housing Act that just got passed by the Senate, called the Road to Housing Act, I think is a good step in the right direction to help maybe loosen some things on the entitlement end, although I think that that's a tough road. But they need to tighten the spread between the 30-year and the 10-year. Now, whether that can be done through Fannie and Freddie is hard to tell, but it's possible. Most importantly, the biggest thing they can do, in our opinion, is invest in the industry. This industry has had negative productivity since 1987. It's the only industry in the U.S. to have negative productivity. So what I mean is off-site construction, manufacturing plants that can make the production process much more efficient. We did a 3-year study on this that just wall panels alone would increase or reduce, I should say, the days on the job site for framing a home by up to 30%. There's a lot that can be done, but it has to be done very rationally and very methodically.
All right. John Lovallo, thank you. Well, a notable tech wreck on Wall Street. Up next, a top tech analyst on whether there's more pain ahead for investors or if this pullback is an opportunity to buy. Be right back. Welcome back to Overtime. Well, tech tumbled after President Trump threatened a massive tariff increase on China. The Mag 7 saw their worst day since April 16th. Those stocks also lost a total $770 billion in market cap today. That's equal to about an Eli Lilly. The NASDAQ falling more than 3%, its worst day since April 16th. Chip stocks, the worst performing stocks in the NASDAQ 100. Synopsys and ARM Holdings do business in China. AMD also down sharply, but up 30% this week. Other recent high flyers outside of chips also getting hit: Shopify, Palantir, and AppLovin. And joining us now is Patrick Moorhead for more insights and strategy. And Pat, we could use more insights. So tell me, NVIDIA specifically, it was hit on China headlines in August and September, but it seemed to sort of take off from that. We're talking about all this open AI-driven demand. How much is this AI narrative exposed to China policy headlines?
John, I think this is a complete overreaction. Let's take NVIDIA as an example. NVIDIA zeroed out all revenue for China going forward. They just zeroed it out in all of their forecasts. But this is a left brain emotional reaction. I mean, listen, I understand companies like Apple, who quite frankly do most of their manufacturing in China and a little bit in India, but NVIDIA and even AMD in particular make absolutely no sense.
Well, how much of this might be about the optimism that it takes from businesses, global businesses, to keep fueling this massive investment cycle? I mean, you've got as good a perspective as anybody on how this lines up on previous technology infrastructure cycles. It's been a long time since we've seen anything close to it, right?
I mean, John, I've never seen anything like this. So this even eclipses .com. I do think with the run-up of so many stocks in the ecosystem, whether it was chip companies, and everybody in between, it's getting so hot that the market was looking for any reason to sell off, and I think they found it. And I also think we can't just dismiss the shutdown. I think all of this is risk, even though right brain, it doesn't make sense for tech. I would understand if we were going into a true trade war with Taiwan. Now that would be very, very difficult, where most of the leading edge chips that are used in hyperscalers are all made in Taiwan. But we're talking about China. That sure, they do manufacture smartphones and PCs, but not leading edge chips.
So in light of that, how does this set us up for earnings, and what are the names you like the best here?
So I do think in the AI trade will be quite strong. So I think it sets us up quite nicely. I think NVIDIA is going to do what they did before, which is do a beat and probably a meet on the forecast, and people will be disappointed in the forecast because it met, because of these absolutely stratospheric type of expectations out there. But I think when it comes to even the hyperscalers, I mean, they are on the move. And I think what was clear from OpenAI's Dev Day of the trillions of tokens that were being consumed out there, and the types of companies, a lot of startups, but you saw T-Mobile in there, you saw Salesforce in there, which I thought was quite interesting, which could be one of the canaries in the coal mine, and where we're talking about these downstream impacts here.
All right, we'll watch it. Pat, thanks. Patrick Moorhead for more insights and strategy. Well, still ahead, a look at the key events to watch next week. Will bank earnings turn Wall Street's attention back to profits, or will the tariff issues continue to dominate?
Plus, why the CEO of an AI defense company is warning of the potential fallout from a rare earth crisis.
Welcome back to Overtime. Sure, there was a sell-off on Wall Street, but a trio of notable names hit new highs anyway. Utility giant Southern Company, energy drink maker Monster Beverage, and pharmaceutical distribution company Cencora.
Well, check out the spike in rare earths stocks. That's after China announced plans to impose more export controls on those materials and some products, including them, targeting in particular the defense and semiconductor industries. China's the largest refiner and producer of rare earth magnets. I asked Tara Murphy-Doherty, the CEO of Govini, this is a U.S. defense tech startup applying software and AI to military supply chains and programs, how rare earths affect not only trade, but also national security.
The rare earths crisis that we're in is a serious one because one of the things that you can see in the data that we have in our proprietary data set tracks national security programs down to the raw materials. So if you are a part of the Department of War or a program office in one of the military services, you have the ability to look at not just what are the parts that go into your system, but what are the raw materials and the critical minerals that are involved in the fabrication of those parts and systems. And the prevalence of material and especially the processed minerals from China is very high. We have a very real dependence problem here in the United States.
Well, Govini, which has contracts across the Department of War, announcing a new round of funding today, now valued at $1.25 billion. It has surpassed $100 million in annual revenue. We also discussed the government shutdown, defense spending, competing with Palantir. You can watch the full interview on CNBC.com. But all those topics will continue to be in focus come Monday as well, because I will be sitting down with the Secretary of the U.S. Army, Dan Driscoll, and you don't want to miss that either.
Looking forward to it. Well, also time to watch Big Bank Theory as those names kick off earnings season next week. Up next, can those results help stocks rebound from today's sell-off? We'll be right back. Welcome back to Overtime. We'll sharpen your pencils to prep for next week's trade as earnings season kicks off Tuesday with big banks J.P. Morgan, Citi, Wells Fargo, and Goldman Sachs. We also get Johnson & Johnson and Domino's. On Wednesday, Morgan Stanley, Bank of America, and PNC report. U.S. Bancorp, Travelers, BNY Mellon, Charles Schwab, and CSX are the big names on Thursday. And the week closes out with Fifth Third, Comerica, Regions Financial, State Street, Truist, and American Express.
Well, on the economic front, we will get the Fed's beige book on Wednesday, home builder sentiment Thursday, industrial production on Friday, and depending on whether the government shutdown is resolved, PPI, retail sales, weekly jobless claims are due Thursday. Housing starts on Friday. The Bureau of Labor Statistics today announcing it will release the CPI report on October 24th. That's after originally being scheduled for next week as well. So let's get back to today's sell-off, how to think about not only today, but how you position yourself for next week. The Dow having its worst day since June 13th. All three major averages ending near session lows. Our next guest joins us with the most important catalyst to watch next week. Vital Knowledge founder Adam Crisafulli. Adam, it's great to have you on. And let's start right there with the downdraft we saw in stocks. I would imagine maybe a little starker even than we'd otherwise see because we're going into a weekend and there's obviously a headline uncertainty here.
Yeah, I definitely think that, tariffs had kind of moved away from the forefront of the narrative for the last several weeks. And so, this definitely, I think, shocked markets. We've had in the last 48 hours or so, we had a kind of a series of announcements from both sides. So it's not terribly unexpected, but this obviously shocked markets and kind of brought tariffs back to the fore. But we were also just very extended, very frothy, very expensive. And so the market was somewhat vulnerable. It could have been anything. It just happened to be tariffs that knocked it lower.
Yeah. So how does that position us then for next week as earnings season gets underway?
So, obviously, I think we'll be on China Watch. We'll be on China Watch throughout the weekend. There aren't any major events scheduled that pertain to China specifically. We will have the IMF World Bank meetings in Washington next week that will kind of be an unofficial forum where a lot of international officials will be gathered in one place. Perhaps you'll see some commentary around the sidelines with regards to trade. But otherwise, aside from that, the focus will definitely be on earnings next week, specifically AI-linked earnings. So you have ASML and Taiwan Semi are both crucial players in the semiconductor AI ecosystem. Though they have earnings, ASML on Wednesday, Taiwan Semi on Thursday. We also have a huge order.
Hold tight for a moment. We got to get to Emily Wilkins in Washington. Some breaking news on tariffs, more comments from President Trump. Emily.
John, yes, Trump just posted on Truth Social saying that he will be imposing a tariff of 100% on China over and above any tariff on what they are currently paying. He went on to say in that same Truth Social post that come November 1st that the U.S. is going to impose export controls on any and all critical software. Trump also saying that this is going to be based on the fact, claiming that China will be taking unprecedented position, saying that he claims that China will be moving first in having large-scale export controls on virtually every product. And Trump is saying that this move by the U.S. is going to be in response to that. And of course, this comes after back and forth earlier today on China having these strict export controls on critical minerals, and then Trump responding to that, threatening tariffs. That now it seems like he is following through on that earlier warning. Guys?
All right, Emily, thank you so much for Eamon Javers' optimistic take that the specifics hadn't come out yet. Taking a look here at Synopsys, which had gotten hit earlier in the year on dust-up over software between the U.S. and China. Adam Crisafulli, you still have him with us? Yeah, let's go back to you on this. The story keeps shifting, and we got a whole weekend to digest it, but we've had a market that's been heavily influenced by retail traders determined to stay optimistic and buy the dip. So what happens?
Yes, I definitely, this is definitely going to be, an overhang now for the next several weeks. It looked like November 1st was the implementation date. So that does give you some time to see if there's any type of negotiation. We've had a series of examples whereby the initial threat, the actual implementation winds up being kind of less than the initial broadside threat. So we'll have to see. But definitely, tariffs are kind of coming back to the forefront. And remember, there's also a huge Supreme Court case, the oral arguments on November 5th regarding tariffs, IEEPA tariffs. And so that kind of is a whole other dimension to this tariff issue, which, again, markets haven't really been worrying about for the last couple of months. So you have tariffs plus a market that was very extended, very frothy already, which kind of makes for a toxic near-term environment.
Does this make Presidents Trump and Xi more likely to sit down for a meeting at the end of the month or less likely?
I think as things stand right now, I'd imagine that they still will sit down and meet. You know, it's kind of they're not getting together specifically to meet. They're going to meet on the sidelines of a pre-scheduled summit. So, you know, assuming both of them will attend that conference, they'll both be there. I'd have to imagine that they will speak at some point in some capacity. And you still have a few more weeks to kind of iron things out, like I said. So I don't think you're going to see 100% tariffs go into effect and stay into effect for very long. But that doesn't mean that, you know, this is a dip that should be bought aggressively initially. At least. I think there's a lot of uncertainty that we have to iron out.
Sounds like it. Adam Crisafulli, thank you. 30% currently is the across-the-board tariff U.S. on China. Obviously, depends on sectors. There's additional tariffs on certain things. This would take us up to what, 130%? That does it for us here at Overtime.
Fast Money starts now.
Live from the NASDAQ market site in the heart of New York City's Times Square, this is Fast Money. Here's what's on tap tonight. New tariff turmoil. President Trump just announcing new 100% tariffs on China. That after earlier threats sent major indices to their worst day in months. The Mag 7 losing near an Eli Lilly's worth of market cap in just one day. The impact and all the ripple effects coming up. And drug deal making, a potential agreement on drug prices and more talk of M&A, the big trends impacting the industry and how to play these moves. Plus, we set the table for bank earnings season, a technical take on two AI names that could be heading in very different directions. And can Baba bounce back? The Chinese tech giant down more than 10% already this month. Is there hope for a rebound when trade tensions continue to loom large? I'm Melissa Lee, coming to you live from Studio B at the NASDAQ. On the desk tonight, Tim Seymour, Dan Nathan, Mike Coe, and Fairlead Strategies founder and managing partner, Katie Stockton. Welcome, Katie. We start off with that breaking news out of Washington. President Trump just announcing 100% tariffs on China above what was previously implemented. The S&P and Qs down after hours. This after major indices all closed near their lows of the session after the president threatened massive new tariffs on China. The NASDAQ, which hit an intraday record early in the session, ended the day down more than 3.5%, its worst day since April 10th. The S&P shedding nearly 3%, while the Dow lost 878 points. All three indices now negative so far in October. Emily Wilkins has the very latest from Washington. Emily.
Hey, Melissa. Well, yes, we're getting this news now of that 100% over and above current tariffs. Now, Trump said on Truth Social that would be going into effect starting November 1st, or, and this is his post, or sooner, depending on any further actions or changes taken by China. He then also adds that on November 1st, the U.S. will impose export controls on any and all critical software. Of course, this is coming after that back and forth that we saw today with rare earths. China, of course, announcing the stricter export controls, and Trump responding to that, saying that he basically saying that they could have tariffs. And now, of course, we're hearing more clarity from it. Trump also said in his Truth Social post, accusing China of taking an extraordinarily aggressive position on trade, and says this, they sent an extremely hostile letter to the world that tariffs and export controls were going to go into effect on November 1st. This seems to be a way for the U.S. to counteract what China's moves would be. And of course, questions here about whether Trump and Chinese leader Xi would be meeting. They're expected to meet 2 weeks from now in South Korea. Trump, of course, earlier calling into question whether it was even worth having that meeting. Doesn't seem to address that in his latest post. But of course, this mention of tariffs and of the export controls really ratcheting up the pressure here and the degree of impact and conflict this could have. Melissa?
Emily, thank you. Emily Wilkins out of D.C. Very busy day today. In the after-hour session, as we mentioned, the major indices are moving lower. We're also seeing deepening losses in the sectors that were most hit during the session on the initial fears that there would be sort of retaliation for what China did with rare earths. So we're seeing semiconductors continue their slide, tech in general. Where does this go from here? We were talking just yesterday, Dan, about how what China did was poking the bear, and here we are now.
Well, it speaks to leverage, and I know Tim kind of mentioned that too. You know, this rare earths has been at the center of the focus as it relates to what we need and what they have. And the flip side of that is like our high-end GPUs that are 90% of them come from NVIDIA. They're made in Taiwan, that sort of thing. And I think when China a couple weeks ago, you know, kind of said to their buyers of these chips, we don't want you buying them. They feel confident with the chips that are being made by Huawei right now. Now, maybe that's a negotiating tactic, but the White House had just negotiated this export deal with NVIDIA. So you put that together, their lack of demand for these chips, and then the leverage that they have over rare earths, it's a real problem. This today, right now, reminds me of April 2nd. We were sitting on the desk. There was this, I think it was in the Rose Garden, this big presentation of these tariffs, and I think we were all expecting something that didn't look like what happened on April 2nd. And, you know, the stock market was already down about 8% into that from their February highs. So you think about that swoon that we had over the next week or so, we did have the president and the administration pull back from the worst of those tariffs. I'm not sure that happens anytime soon. That being said, you know, is this market going to basically be able to take this in stride a little bit? Today was a little bit of a panic, right? You know, next week, we don't have the bond market open on Monday. There's going to be lots of time to digest the stock market, if you will. And I'm not sure we have what we had in early April over the next couple of weeks, because I think the administration knows they don't want the stock market to fall apart. That's a loss of confidence in the administration.
But they have a stock market at all-time highs, and they've got some room. So if I'm the White House, I'm in a much better position to be as aggressive as possible. And I think it's easy to flex muscle with all risk assets, all-time highs. But those are good points, Dan. And we don't usually, we don't always get it right on this desk. But that conversation yesterday was the conversation to have, because we're having the conversation about de-dollarization, and we brought up, I think this is as much about China, and then we brought up that rare earth is really not something that's been settled, and that they're 92% of the world's refined rare earth. Now, over the summer and at different times in the last year, as we've been having tariff conversations, for sure, we've discussed the U.S.'s desire to begin to build away from that, to reinvest. MP Materials is a great example, but we're still talking about 3 to 5 years. So when markets have had the kind of move they've had, there's no question you get this kind of pullback. Katie's going to have some, it's great to have her here always, but on days when suddenly you immediately check some charts and say, wow, are we about to violate some really key levels on the downside just when we were where we were on the upside? And I'll also say, it's been easy to be very blasé about a government shutdown when, in fact, there are headlines coming out every day about AI and trade dynamics that very much include Asian companies to trump and, sorry, I guess pun intended, I don't know, but to override concerns about a government shutdown. It's amazing how suddenly people are saying, hey, maybe with the government shutdown. I mean, banks sold off today because maybe, they're more concerned about growth than ever. Suddenly, the market doesn't just digest tariffs. It digests the second derivative of that, which is growth.
Well, firings out of the government shutdown brings the shutdown to a new level in terms of an economic impact as well. I mean, not just the hit from shutting down, but the hit to there are people out there who are not getting paychecks for sure. But all of this begs the question, Katie, as to whether or not the markets were primed for a pullback period, and this was just the excuse.
Well, it does feel like there was some pent-up selling pressure. Our sentiment metrics were not overly bullish, however, so it's a little unusual that this is happening all at once. Coming into this week, we had our first sell signals from something called the weekly DeMark indicators since the April low was established, in fact, since late last year. So we were paying attention, very close attention now, of course, to momentum gauges, short-term momentum gauges like the 20-day moving average. That is now likely to roll over next week, and that would be our first impetus to get hedged or to recommend hedging strategies. We also feel that the VIX was a great risk metric, and it's been just kind of range-bound for many, many weeks, and now has poked its head up against the 200-day moving average. Looks poised also for some kind of volatility spike. So I do think it's interesting. I think it's meaningful. The sell signals that we had teed up are now confirming.
Mike, do you think that the buy the dip mentality that has been reigning in the markets, has that come to an, is this the end of the road for that?
Well, I think that investors are going to require a little bit more clarity before they rush in and buy this one, because we have a confluence of things going on, and you know any one of these would probably be absorbable I would say, at any point in time. But the combination of the government shutdown, the fact that we just had this is an important technical move we saw today, a downside reversal. The fact that we had gold trading at all-time highs, which spelled some unhappiness with the dollar, I would say, and the fact that we were already at pretty heady valuations for the S&P, I think those things serve as a pretty good counterbalance for what we normally would have to buy the dip, which is that this is seasonally typically a good time and that there's a decent amount of cash on the sidelines. But again, 2 standard deviations above the long-term forward average of price to earnings for the S&P. I think all of those things are a little bit testy, and you can see that there was very much a rush for the typical safety trade. So utilities, X the energy generation and staples.
Yep. I'm glad you mentioned gold. It is ironic that all of these things going on with trade and the, I don't want to say erratic, but unexpected moves by Trump, all of that sends gold higher, and that all strengthens China's hand at the same time.
And the dollar
and the
lower.
dollar goes down. Exactly.
So isn't this a buy the dollar day? Usually the dollar goes lower and gold goes higher. I'm not saying changing of the guard, but boy, that is fascinating. That's part of this conversation. It's not an overnight development, but it's also not going to end. I just point out, too, there's some other geopolitics around here that include China, which is that over the last couple of days, China's been sailing naval vessels around Japan. And actually was sailing them right through next to Okinawa today. I mean, there's provocation. There's definitely bluster. There's definitely some sense that China is ready to, and listening to President Trump, listening to the White House point out the letters that were sent around the world. This isn't just against necessarily the U.S., but also other trading partners. So there's no question China is flexing some muscle, and they're doing it both in the markets and they're doing it geopolitically.
Yeah, when you think about the stock market, and we hear this all the time, Tim, you just mentioned it, that they have a little room to play with, right? So we have the S&P that was up nearly 30% off those April lows. I just feel like, when you have this level of uncertainty, you have this level of just the administration digging in, this idea that the Chinese and the U.S., they really want to save face in these sorts of situations, and it's kind of right out there in the opening. So when I think about a stock market that gets hit the way it did today, and we have this memory of what happened back in, really, it wasn't just April, it was February, it was into March as we were expecting tariffs. But think of these tariffs rates right now. We were coming into this year maybe 3% or something across the board. We're looking at high teens. And if these go into place, in November, well, we're going to have global growth scares. And it brings me back to 2018 when we had a very similar global growth scare, and we had weak demand here in the U.S. We had weak demand, weak economy in China. And so if you think about 750,000 government workers furloughed, if you think about what they want to fire right now, that is one of the threats here. You think about a consumer on the lower end that is having a difficult time right now. You think about inflation. This is the thing. The Fed minutes were telling us last week that the Fed is divided on whether they want to continue to cut rates at the rate that is expected in the Fed funds futures right now. So what do you think is going to happen to inflation if any of these tariffs go into place, given the consumer set? So to me, I just think it's a really tough point just to kind of put a bow on this as it relates to the stock market, because sometimes this stuff can get out of your control. And the last time that we had a proper sell-off, you got to go back to 2022.
Proper meaning 10%.
No, well, I mean, forget April. Go back to the bear market we had in 2022. A lot of the elements were in place that are similar now. We had SPACs, we had unprofitable tech, we had crypto, we had a whole host of just euphoria going on, meme stocks. We have all that right now, and then add on all of this geopolitics and central bank stuff and tariffs.
All right, well, our next guest is more worried about China-U.S. relations now than 6 months ago. CNBC contributor DeWardrick McNeil is Longview Global Senior Policy Analyst. He served in the Obama administration. DeWardrick, always a pleasure to see you. Where are we now? I mean, where are we in the grand scheme of things? I mean, I would posit that maybe it's even more concerning now, because back in April, we saw when we were staring into the worst case situation for tariffs, we knew at least the upside would be talks between the two men. And now we've gotten to that point, and then it was taken away. We saw that China is willing to provoke the U.S. With its leverage. It seems like it's much worse.
Well, thanks for having me, Melissa. Great to be with you and the traders. Listen, for the first time in a very long time, the market sentiment has matched my energy. There's been a real concern on my part that we are just not prepared for what China has been planning for quite some time. The stuff that they announced on enhanced export controls, the legal architecture has been in place to do this for about 5 years or so, and China is finding a correct time to do this for maximum leverage. But let's take a step back quickly, Melissa, and talk about what they've done. They have announced a policy that could either completely halt or severely slow down one of the sectors in our economy that the market has been trading well on. You cannot produce chips at the downstream if you cannot control or guarantee the supply chain in the upstream. And so I think it's time for us to really focus on the main thing and let the main thing be the main thing in these discussions. And that is, how do we break this chokehold that China has in the critical mineral space?
So, Dwardrick, why now, then? Always great to have you. And so, we're talking about this summit in a couple of weeks that was going to happen anyway. You've got leaders that, we're going to be there anyway. It wasn't necessarily about getting together, but China does seem to be going on the offensive. And before I referenced the naval vessels and, what are clearly provocative 2 days of cruising around Japan, why are they doing that? Why is this, where is the I don't want to call it bravado, because I think China's, had felt this way for a long time. I think China's got a lot of muscle they can flex. But it does appear that there's a confluence here, and there does appear to be timing. And I don't believe China does anything happenstance. And here we are in the last few days. The movement in gold has highlighted just how much China has already diversified away from the U.S. And with gold, it does give some backing to their own currency if they're the biggest gold holder and producer in the world. So, sorry, but why now? Why all this now?
Yeah, look, I think there's two ways to look at this, Tim, and both of them are likely correct. In the short term, I do buy a lot of what we're hearing other analysts talk about in terms of trying to maximize leverage for what was potentially, it may not happen now, a meeting on the margins of APEC. And China, look, let's be clear. They still want some things for us, at least in the near term. I think they're pretty annoyed that IEEPA fentanyl tariffs are still in place at 20% when they've made a deal with Biden to do something about fentanyl. They came back and offered a deal to Trump. None of that has moved the dial on the IEEPA 20% tariffs. I think China, despite what we know over the long term, still has a desire to get access to advanced chips in the short term. So they want to see those export controls go away. But those are near-term things. Over the long term, look, I do think they believe that now is their time to really assert China's role in the world, and they don't look to be subservient to the U.S., and they're showing the world that they can stand in the ring and match us blow for blow, and that has diplomatic value over the long term, Tim.
Dwardrick, we talk about rare earths, and obviously China has a chokehold on them, and our defense industry obviously relies on that. But it's not just rare earths. A lot of our supply chain that goes into defense manufacturing really is involved with China. A lot of things that go into a lot of our weapon systems and stuff. Talk a little bit about that. That's something that, to me, should be very frightening. I know Trump, when he was speaking to all the generals last week, he talked about the ships. He loves the ships. Well, we don't make enough ships, and they make a lot of ships. Isn't this a really important part of this whole discussion?
You hit it on the head. Listen, I've been extremely frustrated with both the Biden and the Trump administration, Trump 1, Biden, and Trump 2, because we have spoken very clearly about the chokehold in our defense industrial sector, but not much is being done to really bolster that sector. And so we're in some real tough straits as we look at critical minerals and all the other things that you talk about, Dan, that we're dependent on from China in our defense sector. So, I would like to see Congress and the administration really get serious. Stop talking about it and do something about building the U.S. defense industrial base. We are going to always be at the beck and call and the chokehold of China if we cannot figure out how to build here at home, or here's a novel thought, with allies. Let's re-engage allies. They're still out there. They would still love to work with us, but we have to focus on the main thing. I keep coming back to that.
Dwardrick, great to get your take. Thank you. Dwardrick McNeil.
Thank you, Melissa.
So, Micah, what would you do? What would you be inclined to do ahead of Monday?
Well, there's not much we can do ahead of Monday, is there?
Well,
Market's
in your
closed.
mind, what is your plan as to what you do on Monday now?
Okay. So, I mean, there's a critical level here. About 30 in the S&P is going to be the 50-day moving average. I think if we manage to hold that, that would be a decent show of confidence. Our principal business is selling volatility. So from my perspective, if we do get some dips, we are going to get a big bid to implied volatility. We saw that in the VIX. That's certainly part of it. But, we're seeing it sort of across the spectrum, a lot of single names and certainly the high beta names, which are the ones that fell the most. So, from my perspective, I think it's an opportunity to start scaling in to short vol, because if the VIX gets up to about 30 plus, generally speaking, the next 30 days for the S&P is actually pretty good in terms of its performance on a relative basis.
Yeah, I mean, the way I look at the VIX is obviously as a counter trend indication, a transactional gauge of market sentiment. I feel that this is probably the beginning of the volatility event, not the end. And I say that largely because we have these sell signals that have relevance for about 9 weeks from now. So as much as we didn't get the volatility event in September or early October as is normal, perhaps this is a bit more of a rough Q4 for the broader market.
Meantime, as we had mentioned, safe havens performed decently today. Utilities, staples, shares of Pepsi in particular bucking today's sell-off. The stock up nearly 4%, adding to yesterday's 4% gain. And that came after the soda and snack company topped EPS and revenue estimates, with international growth offsetting lower volumes in North America. The stock, though, still down on the year. Is it time to start switching into safer areas?
For sure, because I think either way, there was positioning that should have been into places, and utilities are this strange, hey, they're not your father's utilities, your mother's utilities, somebody's utilities anymore. But staples are what they are throughout multiple cycles, and some of them are better positioned on multiple here. Pepsi, as you noted, had fantastic numbers a couple days ago. Stock's really taken a couple days even of a run up, not just the immediate reaction on Wednesday. So you have a dynamic here where people are assessing the best of breed companies in there. I do think both snack foods and places that were overly hurt by GLP trends and whatnot. But also, I think there are places in some of the very traditional staples, and that includes tobacco and some of the Unilevers and the Procter & Gamble's of the world that look interesting to me.
Unilever. Safe haven, we also talk about treasuries, right? And so we see a 10-year that's kind of in and around that 4% again, which is, I think, kind of interesting. We talked about gold before. Look at Bitcoin today. Yeah. It got killed.
Not so safe.
Down 7. And that is really interesting to me. And it goes back to what we were talking about 2020 and 2021. Bitcoin was one of the worst performing risk assets in 2022. And it was supposed to be the one that acts well in an environment like that. So, Bitcoin has become very correlated to the NASDAQ. And I just think that's an interesting one because that pillar of the bull case seems to be gone right now.
Coming up, big bank earnings kick off next week with JP Morgan, Citi, Goldman, and Wells Fargo all out on Tuesday. We're taking a first look at what to expect out of these results next. Plus, the White House preparing a new deal to lower drug prices. The details right after this.
This is Fast Money with Melissa Lee, right here on CNBC.